Okay, let me get the presentation pulled up. You guys see my screen? Okay. No, you can't. Just a second. I do that first. All righty. Can you see my screen okay?
Yeah, I can, yes.
Okay, good.
Yep.
All righty, this is where we left off 2 meetings ago. Last week we did Vanahedge, so we'll pick up from here. I guess before we get started with this, were there any residual questions left over from last week's Vanahedge discussion? Okay, we can keep going. At the bottom are reminders. Don't be a pig. Make sure you manage your margin. Those are really the only 2 rules that you must stand by constantly. Don't be a pig. Manage your margin. We're going to get into what I call data discrimination, and we're going to talk about how that applies to the cumulative distribution function, or the CDF. Basically, what we do is we compute a cumulative distribution function, and here we shorten that to CDF, and then we project the results of that forward to make an estimate of what we expect in the future. Okay, but that's done on just one stock or one index or one ETF or something like that. If you can go find an orthogonal measure, meaning something that is independent of the stock itself, but would be useful to further divide that CDF, or that stock performance, into separate subsets. Sometimes you can get an additional edge. Let me give you a great example. Okay, every stock has an average price earnings ratio. You can compute it. What is the price relative to its earnings over time? You can figure out what the average of that is. And so therefore, with price earnings, you can make the determination of whether or not the stock is considered expensive on its own history or cheap on its own history. And now you have 2 sets of data. Okay, with those 2 sets of data, you can then go compute a CDF for each of those and have a result for when the stock is expensive or when the stock is cheap. You following me? Yes? No?
Yep.
No? Did I hear a no? If I heard a no, say yes.
I said yes, following you, Peter.
Okay, everybody's following me. Good. What that allows is something that will usually end up being closer to the money, or give you an additional edge over and above what the CDF would for the options market, and provide you with some additional information that you wouldn't have otherwise gotten out of just the standard cumulative distribution function. Okay. Note that oscillators, like what I show up there, they're not good discriminators. Can't really use those very well. They don't work, but PE does, PEG ratio does. Something like interest rates, how does the stock perform when 10-year treasury is at a certain level versus when it's at a lower level or a higher level or whatnot? You can use interest rates for that. That can work, but you need a lot of data history then for that, because interest rates don't change, or at least they shouldn't change very dramatically over very long periods of time. But discriminating the data gives you a new way to look at the information, and usually what it does is it provides strike prices that are closer to the money that themselves have never lost. Okay. In our data set that we have, the SPX AI weekly data is discriminated. So is the daily data. It's discriminated. And that discrimination allows us to match market conditions better than what we would just out of the straight SPX screener data. Okay. Any questions? All right. We're going to talk next about the valuation of what I call calculation memory. In our screener files, we have these, I guess they kind of show up as pink, but they're meant to be red, blue, and yellow colors that highlight whether or not something is considered to be overbought, oversold, or nearly overbought or oversold. And those indications are based upon what I call screening limits, which is actually saved information. Okay, so we're going to talk a little bit about calculation memory. And all calculation memory is something that says, you know, we made this percentage calculation n number of days ago. How does that compare to what today's calculation is? So when in the screener data, when we determine whether a symbol is overbought or oversold, we compare, for the level one, we compare 40 days worth of 1% calculations. Okay, down here, 40 days of 1% calculations, and for the lower level of that, which would, if it's violated, that would be something that was oversold. The lower limit is the maximum of all of the 1% minimums for that day, okay, or for that symbol. The upper limit is the minimum of all of the maximum calculations for that symbol. All right. Max value of all the lower limits and min value of all the upper limits to set the overbought, oversold. Level two is if it represents when that symbol has violated never lost, meaning that in its history, the market has never moved that far, that fast, either up or down. And that's when momentum has truly run amok. And we had a lot of that here in the not too distant past during that 9-week straight up grind from the lows in March. Semiconductors especially, they were historically overbought during a period of that time. And then, of course, that all came tumbling down in one day when it crashed 10%. Any question on using calculation memory? Basically this portion of this slide. Any question on this part yet? Okay, so let's walk through how this works. It's been about a year since I went through this, so we'll be doing this together. These are days where, let's go look at what this is. Resulted in the screener limits for MSTR. So how did we get there? These are all the 1% limits, both lower limit and upper limit for MSTR for 11/29/24. Okay. This is the raw data over here. The 1% raw data corresponds to the 1% screening limits. The never lost data corresponds to the never lost screening limits. In our screener data files, in the colors, this represents level one. This represents level two. Okay. Essentially, what we're going to find when we go through this max min calculation, this was done for 10/7/2008. We see that with the current screener level of 56.34, that was from today's calculation right there. Okay, and that would represent the 1% screening lower limit for 10/8/2004. The upper limit, or the lower limit on the never lost side, is 13.57. Okay, Note that 1194 is also right there. 15 would go there, 16 would go there. This, however, 15.5543 was not greater than 16, so 16 stayed. 17.7 there, 17.5 was not greater than 17.7, so 17.5 did not replace it. 1634 didn't replace 1770 for this date. 1620 didn't replace 1770 for that date. Kind of getting a sense of how these go. These are the maxes of all the min calculations from this column. On the upper limit side, we have the mins of all the maxes. So we need something lower. 774.92 matches what that day's calculation was. 774.92 here does not match this calculation. 774.92 does not match this calculation. 769.02 does match this one. 727.04 does match this one. 917 is greater than 727.04 there. 867.38, et cetera, et cetera, et cetera. You getting a sense of how this kind of works for both sides? This is what happens in the screener files that we put out every single day.
So what does it mean then when there's a discrepancy?
Well, like for which date? Give me an example.
Well, just one of the ones you pointed out, it was like 10.9. The upper limit was 866, but it didn't match the upper limit in the never lost screen.
So 866 right here.
Yeah.
It's greater than 774.92.
Yes.
So it won't replace it. Remember, the upper limit is the min of the maxes.
Okay.
Well, the minimum is 774. That's not 866. And the lower limit is the max of the mins. 1357 right there. Okay. What the rationale for why we do that, what this is trying to do is sort of resolve from a very, very wide calculation way out in the future to something that narrows down around the actual stock price on the day that you're looking at. So in other words, we're trying to say, well, while the raw data, the calculation for today shows these were the 1% limits, over time, the 1% limits resolve to something narrower than what we had for this particular day. And that can give you an edge if you use those screening limits. Like for instance, when I trade never lost, I don't look at the current day. I look at the screening limits because every calculation in there was never lost on the day that it was made. Never lost on the day that it was made. Say that again. Never lost on the day that it's made. And unless that's violated in the future, it remained never lost. Stayed never lost. So you can get as close as you want to that, but unless the stock price actually, or the index or whatever ETF actually trades above that never lost level if it's the upper limit, or below the never lost level if it's the lower limit, it doesn't count. In other words, that never lost level gives me an edge relative to today's calculation. Okay. So I don't trade
And those
lists.
are closing prices.
What's that?
Those are closing prices. It can
Yes,
trade above or below it intraday.
Always closing prices. Remember, why do we use closing prices? Does anybody want to give me that answer? Because this is intended for trading options. Okay. And options and the option price closes, or the option price, the final option value of that price is determined at the close on its expiration day. So I don't care what happens intraday or the day before or the day before. I care what happens at the close on that expiration day if I hold it till that period. Okay.
So Peter, if I can just replay that last piece you mentioned around you generally trade the never lost screening limits and not the date start. In this case, basically MSTR, right? That's what this is. Yeah.
Yeah, this is for MST.
yeah,
This was
yeah.
way back. If you
when
remember
we were
right.
having too much fun with it.
Oh yeah, when we were having way too much fun
Yeah.
with
But
Good.
like, so if MSTR, let's say, was trading at on maybe the first day here is 10/7, right? 2024 was actually trading at 750.
it. Yes.
So it has not reached that your never lost screening limit. So if I were to gonna go sell never lost in the future, I wanted to sell some calls. And if, let's say I wanted to sell on 10/17, 727, which is lower than where my spot was, it's still a safe bet.
It is, until it's violated, it is
Yeah.
still considered to be a safe bet.
Well,
Now,
violation on
let's add
10.
the caveat. Let's add
Yeah.
the caveat to that.
Yeah.
Okay. How do I determine what my odds are for never lost? Remember, never lost does not imply will never lose. It just says I have never lost before in the past.
Yeah, since the inception date. Yeah.
Since the inception day. So it depends on how much data I have in the screener for that particular symbol. So if I have 5 years worth of data in there, approximately how many data points do I have?
It's about 1,500 or
1250.
12. Yeah, not even. Yeah.
There's roughly 250 trading days per
yeah.
year. So 250 times 5 is 1,250, which means the odds of never lost following through on any given day is 1 divided by 1,250. That's what my odds of losing are. If I have SPX, something like SPX has, we've got data going back to the beginning of January 1962. So we have 64, almost 65 years worth of data there. Okay.
Yeah.
That's like 16,000.
Yeah.
16,200 and some odd data points. Maybe it's a 300, but somewhere in that period of time. So my odds of losing on a never lost for that is 1 divided by 16,300. Feel pretty safe about that.
Okay.
So it's always important to understand how much data that you have when you make that never lost determination, because never lost does not mean it will never lose. Like let me give you, and let's talk about this in terms of probability. Over the next 65 years, there is a very, very, very good chance that one or more of the lower or upper limits for SPX will be violated, never lost. Good job at that. Because then I've only got half the data. I only have half the data to project that far in the future. But the odds of that happening tomorrow are 1 in 16,300.
Yeah.
So it's not likely to happen tomorrow. It becomes more likely if we were to think about it. I make that same bet every single day for 60 years. Eventually it's likely to be violated. Okay.
Cool.
We can run through the Taylor series expansion to go figure out exactly what that is. Basically, it's if there were 16,300, then I have 16,299 over 16,300 for tomorrow. The next day is 16,300 divided by 16,301. So I keep multiplying those together for 60 years worth of data, and then I find out what my probability, that Taylor series, what my net probability is after those 60 years of having one of these never lose. Okay.
Cool.
Just not going to do the math right now today. That's not that important.
Yeah, I mean, I was just looking at from trading. I think for SPX at least, I have been taking the no loss since 62. Whenever the put spread opportunities arrive. Instead, what I'm hearing is if I should take the higher of either that or whatever that never loss, that screener limit might be.
Yeah, you got to remember that when this calculation is made, these represent at some point in time in the past, at the time that that calculation was made, it is never lost. And in order for never lost to lose, that calculation has to lose.
Yep.
Okay. Okay. Sounds like I
Did you breach that in COVID at all ever?
yes, COVID did. COVID did. You know what? If you want, I can put in the Discord. I actually have a record of what all of the never lost states are for 1 day through I think 60 days. So I can post that if you want. I'd have to go dig it out, but I do know what they were. But COVID did breach never lost for SPX. I think the other ones were 2008, 2009, 1987 is the 1 day. There were some in the 70s for longer. Yeah, I know what every single one of those was, or what day that they all occurred. And so, you know, it kind of depends. I mean, everybody remembers October 1987, the day that the market crashed 20%. That's the never lost for 1 day. And it's unlike that particular day is unlikely to be breached because the market has the circuit breakers in place now that it didn't back then. But yeah, COVID breached one of the shorter term ones. No, and that was interesting trading times. You get a VIX of 82. I remember my son and I, we were getting, for strike prices somewhere 23-24% below the market that day. This is pre-zero DTE, but we did have Monday, Wednesday, Friday options back then. And I want to say it was a Wednesday when this happened, but on one of the days when the VIX was up at like its high, where it closed at the all-time high, we were able to go get 23-24% below the market that day options that would pay us like $1.50, and we took as many of them as we possibly could, just knowing that they couldn't possibly lose. It was impossible to lose.
Yeah, I mean,
The
circuit
only
breaker
thing
would have
stopping
kicked
us-
in, right?
What's that?
The third one stops the trading for the rest of the day. So the worst
At
case would have
20%
been
down.
at 20% down. Yeah.
Now, it doesn't necessarily settle at 20% down. It stops at 20% down. So there's a little bit of a buffer that you kind of need in order to have that true guarantee. But that was how crazy option prices were. And the only thing that stopped us from taking more was broker margin requirements. We maxed it out. And of course, we won that day. You know, that you were guaranteed to. But that's some of the wildest trading I've ever seen was back then. So remember, each of these calculations too was a 1% at one point in time. Okay, at one point in time they were 1%. For at the point in time that they were taken, they were 1%. At the point in time these were taken, these were never lost. Okay. This is just more of showing all of that again. If you want to look through this to understand it more, this presentation is available on the Discord. See, what is my note at the bottom? Note the upper screening. We're both set before the election, despite limits court. This was around election volatility. See, we're going to have that again this year. It's a little bit more milder in off presidential years. Presidential election volatility. I've been doing this since 2009. Every presidential election seems like we get a move around 5%, and you do get a VIX spike around it, regardless of who's running for president. This was MSCI, SMCI, just more. Oh, this is a condition that we see quite often now. Note in this particular case, the lower limit is greater than the upper limit. This is absolutely, truly run amok. Volatility here. Same thing on the upper limit down here. Usually when we see that, you'll like for instance, in I think Friday's screener, if you look at the colors only, what you'll see is something that makes no sense. You might see an overbought condition for level 2 and an oversold condition for level 1. That's because the screener limits are messed up. Like this, the hidden assumption when we compute these is that the lower limit will never exceed the upper limit. Well, sometimes it happens, especially if there's not a lot of trading history with the symbol. If this ever happens with SPX, God help all of us. That probably mean, and I'm going to predict how that can happen. It would happen if the market truly had a crash where we dumped 30, 40, 50% in the week, then you could get this kind of result. I don't ever want to see that. That'd be absolutely ugly. But if you have something where that's a relatively new issue, then yeah, you can see this happens. I've seen this on ASTS. It's only I think it's like maybe 6 years a public company. Sometimes we see this on things that have traded a little bit longer. SMCI, this was in the this was before it had its fraud issues and things like that, when it was just going to the moon. And this is kind of the explanation for why. And here's the big takeaway. Never lost does not imply will not lose in the future. Just because it hasn't lost in the past doesn't mean it won't lose in the future. Any questions on all of this?
No.
All right. Okay, so there's my note from way back when I taught this last time. Screener data deep dive. Basically, the takeaway is what you're supposed to get out of all of this. I don't use options in the way that they teach you in options action on CNBC. For me, it's a bet. It's a bet. When I sell an option, I'm making a bet that that option is going to expire at 0 with a certain probability. That's solely what it is. The screener data and the SPX AI data allow me to make that bet with a given margin of safety. I go into the trade having an expectation of what the probability that particular trade is going to win is. Simple as that. So for me, the market truly is a casino, and I am truly betting. That's the way it is. It's just what, and I understand all of that. I've always said that I'm the world's worst stock trader. I don't have a good understanding of why a stock moves on a given day, and when I take a position in a stock, I don't have conviction that I understand exactly why it's going to go up in the future or why it's going to go down in the future or anything in between. I have more safety in the SPX index because I got a lot of things around that. Like for instance, here recently we were overbought rather heavily for SPX, and I was selling calls against that. That's my expression of saying that I believe that the S&P 500 is overbought and it's due for a correction lower. Exactly when that happens, I have no idea. I can't give you a level. of when that should happen, or a day that it should happen, or the catalyst that'll cause it to happen. Don't know. But when I take my call option, which is an expression of that short, I have a certain probability that's expressed in either the screener data or the AI weekly data that tells me I know what my odds of that that short call that I'm doing is going to win. Know what it is. We have a number of different calculations that we publish every day. We publish never lost for every stock symbol. We publish probability tail information. Usually that's expressed as 1 in n years. Okay, so if I say that something is a 1 in 5 year probability of happening, what am I really saying?
Same, 1/1250, right?
1/1250. This number 251.75, I think, is really closer to 250 now because Juneteenth is now a holiday. So, but 1 in 10 years is the same as 1 in 2,500. Just think of it that way. That's what it is. Saying it 1 in 10 years makes it sound like it's a lot, when in reality it's 1 in 25, 17.5, or 1 in 2,500 thereabouts. That's what it is. Okay. So again, my option trades are bets. That's all it is. It's just a bet. And it's a bet where I know what the probability of success is going into it. There's nothing all that much more complicated about single bet. I suppose we could go into Wireless's stuff a little bit. His is a spread bet where it's a vertical spread on either a put or a call, where he's computing the probability of the short strike losing and the long strike not losing, and what he can get paid relative to what the combined probability of those two pieces are for the stock actually moving into that particular range. And in his case, he's using it to say that I'm the casino, meaning that if I took this bet over and over and over and over and over multiple different times, I would win, just like casinos do. You go to a casino, the odds are not in your favor. There is no game at the casino unless you're good at card counting or something like that, where you can change the odds into your favor, unless you're playing against another human being. Poker is one where people that are really, really good at poker have an advantage because they're playing against another human being. Blackjack, unless you can card count, the best you can do is a 49% probability of win. And every game is below that thereafter. So casinos make money because the odds are in their favor over time. There's only one guy I know that failed owning a casino, and he just happens to be the president. I'll say nothing else lest we get into politics. Screener worksheet. This is, we have two of these. We have Screener 1 and Screener 2. This is essentially what Screener 1 looks like. If you were to just look at it by itself without the colors only. This is way back from some point in time before, but this gives you a snapshot of whether something is overbought or oversold. In this particular case, we're showing MSTR to be oversold at level 1, which means that it fell below the 1% screening limits. Stock actually closed below the 1% screening limits. Amgen is close to being oversold, and we know it's close to being oversold because it's less than 0.1. Okay, numbers in this table that are below 0 are oversold. If they're above 1, they're overbought, and if they're in between, they're neither overbought nor oversold. But we do highlight the ones that are less than 0.1 or greater than 0.9 in the calculation. Here we have General Motors being oversold at the 1% level and nearly oversold for never lost. Note that the data though only went back to 2010. Okay. If you remember right, for 2010, you'd say, well, GM's been around for like 100 years. Why does data only go back to 2010? Well, General Motors went through a controlled bankruptcy where the government basically bailed them out during Obama's term, and they reissued stock back on this particular date in 2010. And that's why we only have data for GM back to that point in time. Okay. This is basically just saying what I already did. Symbol data lookup. This is where we go look up tail information. Okay, the probability tail information. This is where raw data for never lost is, raw data for once in every 10 years, once in every 5 years, once in every 2.5 years, once every year, once every half year, and 1%. Note they go from farthest away, tail farthest away, to closest in that order. 10 years has a lower probability than once every 5 years, which is less than once every half year, which is less than once every year, which is less than once every half year, till you get to 1%. So you may seem like once every half year is, that happens a lot, but that's actually more restrictive than 1%. Because there's 125 days, trading days in a half year. We also show the screening limits over here. Okay. In order to put in a symbol that you want to look up that might be in screener data 1, you just click in and cell F2 and you type in the symbol name. There's a list on the Discord of symbols that are contained in the overall screener, and I do need to go update that because it's a little stale now. But it also tells you which screener file it's in. Type in that number here and it'll populate the screener with that particular piece of information. If there's a earnings date coming up for that particular symbol, then you'll see the dates for that earnings day, and I think there's 10 or so beyond that in chartreuse over in the expiration column. That's just to warn you that, hey, earnings are coming up. So this isn't a bad place to go find out whether or not there's earnings on the horizon. And I also specify it right here. Here's how you change the symbol. Dates are in a row, trading dates. Yeah, okay. These have no calculation memory. In other words, that was based upon yesterday's close. This is with the calculation memory. This is what the basis for overbought or oversold is. This is the calculation to determine overbought or oversold up in that left-hand corner. That's really just for me, if you will. This is kind of detail on what all of that stuff is. Okay. Here's how you make that calculation. If you're really all that interested, just know that this exists in the presentation. Note that there's nothing in either calculation that stops the lower limit from being greater than the upper limit. It can happen, and it does. Any questions on this so far? All right. Go ahead.
No, keep going.
All righty, excellent. This is Friday lookups are just the Fridays. If you're interested in just Fridays, lots of stocks still only have Friday expirations. This is a little dated now because at the time that this was made, everything but SPX and a handful of other ETFs had Friday expirations. Now I think there's more and more things that have 0 DTE. But this is just a condensation of what happens on Fridays. Price versus probability spreadsheet starts with the 1% levels of the CDF, and it goes all the way to the 99% levels. And the way you read this is the probability that the probability that the stock will close less than that value. Okay. So for Apple on 11/27/24, the probability that Apple stock closed below 221.08, I think that's what that is, was less than or equal to 1%. 226.70. Man, I can tell I'm getting old. I almost need a magnifying glass. 226.71 was the 5% limit. And then way up here at 250.8, there's a 99% chance that Apple that day is going to close below 250.8. And you can find out what the probability is for every single one of these dates here by just looking at this big old matrix. Something I do want to highlight. See column L, that's 50%. That's the median. So it says on this particular day, based upon yesterday's close, the median close for Apple stock that day is 235.47. Okay. It's the same the next day. The day after that, it's slightly higher. The day after that, it's slightly higher, et cetera, et cetera, et cetera, et cetera. So it says that Apple stock appreciates in the future. Okay. Did you know that UNG does not? UNG goes down. Did you know that UVXY goes down? Did you know that VXX goes down? Did you know that USO goes down? Not all stocks or ETFs have an expected value that their median goes up. You guys know that?
I get the UVXY and the VIX based stuff, but in USO's case, it's just because of expenses or because
USO is an oil ETF, right?
Right.
So how does it have to trade? It trades
Like
futures.
Hmm.
So usually things that trade futures have rolls in them, and they tend to go down. UNG that has the same issue.
Got it.
Okay. So if you're buying something like USO to express a bullish outcome for oil, there's decay in it that you may not know about. And the same thing with UNG.
Yeah.
Of course, the levered ETFs, something that's 2 or 3x, they don't go up 2 or 3x. They have decay in them as well. Same thing with the shorts. Okay.
Yeah. And
So
they only follow the daily movement. So it's not.
Yeah, they're only meant to follow the daily movements. That's what they're designed to do. But they have decay relative to that particular multiplier over time. If you have a question about whether or not the ETF that you're going to look at, and I screen it, just go look at column L, in the price versus probability lookup, and you can see how the price moves, is expected to move over the. This is the median value again. Median value, sometime in the future, Apple appreciates. That's all I wanted to take away from that. How much it appreciates, I can compute. Okay. But this is my expectation on Apple stock based upon its prior trading history. Not everything does that, and most people don't know that. I will argue that if we were to survey the Discord and ask them how many people in there know that USO tends to depreciate over time if you buy and hold it. My guess is most people didn't know that. UNG may be the same thing. Okay. But this is where you find the other parts of the CDF in sort of piecewise. And remember, that's what we computed to get this. This is just legs of the cumulative distribution function for how price changes for Apple stock. Here's where we present more of this. No calculation memory. This is based upon it's recomputed every single day. One thing that this is good for, let's talk about, say I wanted to buy Apple stock. And I only wanted to buy it if it was in the future, if it was at some percentage below where it's currently trading. In other words, I wanted to get it cheap. So first of all, you have to define what cheap is relative to where it's currently at. Is that the 1% level? Is that the 5% level? Is that the 10% level? Is that 15? And then at the same time, if I own Apple stock and I would like to get out at some expensive level, if it kind of runs amok, well, is that the 95% level or the 99% level? Basically, this is giving you what those strike prices are for the future. Okay. So if you wanted to buy it with a cash covered put, this table can give you what the strike prices should be to be able to do that if it fell below 5% or 10% or something like that. Phil, I think you've done that before. In fact, I think you've also used this table some for your EV. Any questions on that?
Correct.
Oh, that's a cool hack around the wheel strategy, I guess, to kind of as a starting point.
You can use it for the wheel. Yes, you can use this for a wheel strategy if you wanted to. I'll let everybody else go look that up. That's what is it? It's also the triple income or something like that. There's another name for the wheel strategy. But you can look that up online, see how that trades, but you can use a table like this for that. Any questions? Okay, SPX AI limits. We publish these every single day as well. They're slightly different than the screener in that they use discrimination. Okay, there are upper and lower boundary limits that are specifically designed for use with the S&P 500. I have a project that I haven't finished, which would allow us to compute the same sort of limits for the Russell 2000 and the NASDAQ 100. And once those two are done, then we'll start publishing those daily in the Discord as well. But basically, we're using discrimination to sort the S&P 500 open and close data into subsets. We have weekly data that is 20 subsets and daily data that is 10. Note I publish something that only goes out 5 days in the future, and something that goes out 8 weeks into the future in the weekly data. Actually, it goes out 12, but I only chart 8 weeks. This uses calculation memory, just like the screening limits did. Okay. In the weekly data, there's 40 data points. In the daily data, there's 5. This allows us to have something that currently fits the market conditions a little bit better. If you followed along on this and you look at that chart every single day, out in the future, the limits are fairly wide, but over time they tend to collapse around where the index is actually trading. On occasion, we end up with the market running amok again, like we had recently, where you'll breach either the upper limit or the lower limit. Given the amount of data that we have that we're using in the discriminated data sets, which is about 185, we should have 1 to 1.5 of those in each direction each year. So this is sort of this is for what I do. This is the first set of limits that I ever traded off of. I used to use these weekly data limits. Back in that ancient history period of time, all I had was weekly expirations as well. Back in 2012. Prior to that, we didn't even have weeklies. In 2009, they were monthlies. But I used to compute these weekly data limits back in that particular period of time. Okay. Estimates for Friday closes, two-step discriminator. This is now old. It's got about 185. Okay, more of that. Here's kind of what they look like. This is from an older chart, but notice the blue line, which is the S&P 500, tends to ride in between the green and red line. There are some dips below it, but they don't count unless they close on a Friday. Okay. This is what we see in tabular form. This is what they look like over in the future. The daily limits are over the next 5 trading days. Those got started. I'll tell you the story behind that on how the daily limits got started. This is really to support zero DTE trading. I created those while I had COVID over the July 4th holiday in 2023, right there, and I was bored. So that's how the daily limits got created right there. Nominally, at that particular point in time, there was about 870 data points. So Never Lost has a probability of about 0.115. It's actually a little bit less than that now because we've got a couple more years. Tabular form, this is what they look like. We publish only 2%, 1%, and Never Lost. Note that 1% can happen. Like Duvall is on, he can tell you that from personal experience.
Yes. Friday.
Never Lost has been breached one time since the 28th since July 3rd, 2023, when they were created, and that was April 8th, 2025, on Liberation Day. The lower limit for a day actually got breached. And then, of course, because the AI learns, it's now that breach is now corrected, so it won't happen again. It became the new Never Lost, if you will. Any questions on this? Note that these use the discrimination that I talked about earlier. We divide the data into subsets and then compute the CDF on each subset of data.
So those values change daily.
Which values?
The daily limits, the AI limits.
So these use that same property of calculation memory. Okay. So the 2% limit for the lower limit is the highest of all of the 2% limits for that particular day. The upper limit is the lowest of all of the upper limits for that day, etc. So these use calculation memory in them. So do the weeklies. Okay,
So
these resolve.
So I guess my question is, so if that was the data for a Monday, on Wednesday, was Friday's data still consistent, or does that alter?
Well, so here's maybe this is the way that you're asking the question. Are these numbers down? So if this is today, which it was at the time that I did this, so this must have been the day after Thanksgiving in 2024.
Mm-hmm.
Are these valid numbers down here? can I trade them? Is
And
that what you're asking?
I guess what I'm asking is, so if I come in on the 3rd, are the numbers for the 6th? I guess I'm answering my question by your response to it is saying that for this particular day, that information is accurate. But what I guess what I'm wondering is if on the 3rd, is the data for the 6th going to be the same, or does that adjust?
Well, on the 3rd, it depends upon what the market did. Okay. So in between. So if there was a calculation on the lower limit that was higher than 57.57, because I've got a calculation that I'm going to make on the 2nd and the 3rd, then this will adjust higher, but it will never go lower.
I see. Okay.
And then on the upper limit, this might adjust down, but it will never go higher.
Okay.
In other words, these already set that bound. Back here, same sort of thing. Like if you look out here, this is January 17th, 2025. What this is telling you is, I don't know what that particular, well, here, we know right here, 54.65. Okay. That's the AI weekly lower limit for that day. You will not calculate something lower than that. It will only go up. Nor on the upper side, this can only come down, can't go up because of the constraints that remember, it's the max of the mins of the maxes. So these are already valid limits to trade against if you want to go that far out in time. Same thing here. And I do that. Sometimes I will find like on the Friday where on the jobs report Friday recently where the market took a nice dump lower, I did use the never lost daily AI limits to trade into this past week, and of course they didn't lose.
Nice.
And I used the numbers that were published in the table from that Friday.
So historically, I have only used this for 0DTs, but I think what I'm hearing is it's okay for farther dated out as long as, right?
Realize 1% can still lose.
Yeah.
Never lost doesn't mean never will lose. It's just that I have, with 870 data points, the odds of me losing on any given day in the future are 1 in 870. I feel pretty good about that. At the same time, I'm not going to necessarily be a pig with it. I'm not going to go all in on 1 over 870. But trading making a few extra bucks here or there, especially if it's going to be the weekend and I want to watch a World Cup game and I can at least make beer money with it. There you go.
Boy, that would be a lot of beer.
I got to tell you a story. So there's someone I know who uses these daily limits for Starbucks. They only want to make $5 or $10 or something like that. So this is their Starbucks. They go make a trade. They then if they can get $50 out of it, they've got Starbucks for a week. So
maybe you should at least tell them that to upgrade to a better coffee, use that money.
I don't. That's one of those. That's probably fighting words for some people. I don't know. Any questions on any of that?
Nope, that was good.
All right. Let's talk about use cases real quick. We've gone through some of them. You can find this. This is when our data is. We call it blind squirrel now. This is under the Slate Trader main tab, if you will. And I kind of like the blind squirrel because it's cheeky. The old blind squirrel finds a nut every now and then. Well, we know what the odds of us finding a nut are. They're pretty good. So we were pretty fat squirrels for the most part. But these are all the uses that I know of people have done with that. Phil has taken some of this to a new level with his casino expected value bets and things like that. But you can do all kinds of different trades for different reasons, if you will. Like risk substitution is one that I do a lot on the call side. Here during that run up over the 9 weeks, calls are when at one time I mentioned that I never Vanna hedge a call, and Phil kind of said, well, why couldn't you? And I guess you could, except that I'm never really worried about Vega for call. I'm not worried about volatility, because volatility tends to go down. Implied volatility of an option tends to go down if the market's moving higher. And so on calls, I'm really more worried about delta. So if my call looks like it's going to be at risk, and this again is where not being a pig matters a lot, I can move it up and out. I can move it up in strike price and out in time. That's risk substitution. Okay. I don't like my current position. I can go move it farther out in time and up to where I don't lose any cash in the transaction. And then all I'm doing is really waiting for some sort of market correction or break in momentum, so that the call goes and decays back down to zero. So in other words, I made my money. It just took me a little longer than I thought. On calls, I do that a lot. On puts, no, I don't, because I don't want to have the risk of the future being worse than what it currently is now. If I don't like my put position, I get out of it, I liquidate it, and I take my loss there and I move on, so that my loss doesn't get into being something really, really, really big. So from a risk point of view, if you're trading options, as long as you're not a pig, on the call side, it's really, really, really kind of hard to truly lose if you're being reasonable with the amount of risk you're taking in the initial position, and you're not being a pig in terms of the number, because you can use risk substitution to eventually get your money. On the put side, if the market moves against you, you need to have a stop or a way of getting out before things cascade against you. That's how I mentioned that we had a never lost for SPX in March of 2020. If you tried to hold on to that position, it could have been catastrophic against your portfolio. For puts, you have two things working against you. You have Delta and Vega, and most people get in trouble if they're trying to hold on to a position for longer than what is reasonable for that. And frankly, I've got a new name for, what you don't want to do is you don't want to Captain Condor yourself. Everybody familiar with Captain Condor and what happened? If you're not, tell me, I'll tell you the story.
Yep.
I'm not familiar.
All right. Captain Condor used the Martindale, I think it's Martindale. Is that Martindale betting strategy? Isn't that what it's called, Kim?
Yeah, Martindale.
Yes.
Yeah.
Spot on, yes.
So he would sell 0 DTE iron condors, which is basically a vertical call spread and a vertical put spread. So he needed the market to stay within the call strike price and the put strike price, so that before he could get all of his money. And he had tight limits on his calls and puts. I think they were $5 apart or something like that. So they were pretty tight. And what he would do is, if he lost, he would go the next day, replace the bet, and increase the size, so that basically, if he wanted to make, let's say he wanted to make $100 on the first day, but he lost $500, then he would try to make $600 on the second day because he lost 500 and he still wanted to make his original one. Okay. So he'd increase his bet the next day and replace it. If that lost, then he was down $1,100 and he needed to go, or down $1,000. And if he still wanted to make his $100, he needed to make a bet of the size of $1,100. They did that he and his followers did that just before Christmas, and the market continued to move against him on every single one of his bets until on Christmas Eve, he lost all of his money, $50 million. He and his followers lost $50 million. Do not ever Captain Condor yourself. If you've got have a priori knowledge of how much you're willing to lose on the trade, and don't, in fact, put it into a stop order. It's the best way to go do it. Is if I don't want to lose more than this on this particular trade, make it a stop order. A good to cancel stop order, and let it stop out, as opposed to letting emotion say, oh, well, the market's going to turn around and I'm going to go make my money back. Yeah, oftentimes that happens. In fact, it happens more often than not. But on the times when it's not, you can lose bigly. Don't be that guy. Don't Captain Condor yourself. That's how you make money at this. When the market's moved against you, you get out when the losses are small.
So, Peter, on that stop loss piece, right? At least if I'm doing put spreads or call spreads on these 1% or no loss strikes, at least I've been burned a couple of times on the put side where I had a stop loss in, but at a 3x the credit that I would have received. And man, I don't know whether market makers are watching your stop loss. Like it comes and gets to that 3x limit, and then even with a very minimal price movement, and then I was stopped out, which I would if I were just monitoring it, it would have been fine. So I've seen that, and of course I have seen the other side of it as well, where you don't have a stop loss and the market moves so fast that you lose your chance and you end up losing significantly more. So it's a freaking double-edged sword when it comes to stop loss on these way out of the money puts and calls.
Deval, you have to watch volatility, because in this day and age, VIX is not only our best friend, it's our worst enemy. That's all I'm going to just say. And maybe think of taking slightly smaller positions. And I'm only speaking from being burned probably 10 times as hard as you've been, like Peter, in the past.
So when you say like if the volatility is rising, basically just take that stop and don't even bother, right? Like
the chances are too, you're gonna hit your stop, and then later in the afternoon you'll go, oh shucks, had I held on to it, I would have made my money instead of losing a couple $100. You're better off losing a couple $100 because there's only one stock market transaction. It's your entire life. If you're going to look at this, like Peter's saying, as a gambling thing, it doesn't matter what you make each day. Did you learn something? You make $10,000 one day, great. You lose, $20,000 the next day, great. Just keep going and manage. Like you said, don't be a pig. Manage your margin.
The big thing of it is, so like if my portfolio gets liquidated, that's how that happens for me. I don't think about it. I just move on. Okay. It is what it is. I don't really care. I'm glad that at that particular point in time, I'm glad that so for me, I've got a lot of experience doing this. I've been doing this for pretty close to 17 years now. And if you want to think about it from it took me 2 years to develop the basic strategy, way back before there was anything called AI and you didn't have access to data like you got today and all this and that stuff. And computer technology was nothing like it is. So I've been really kind of doing this from a study point of view for 19 years. You don't survive doing this for that long if you don't do these two things right there. Don't be a pig, manage your margin. Part of not being a pig is understanding that if it's time to get out, just get out, get off. With the entire development of the Vanna hedge, which was in the last, in fact, it was the entire last class, was all about trying to manage a bad trade. or a bad series of trades. Okay. That's all it was. You think about it. I want to get out. I don't have time to close all of these. Or I've got my stop losses on, but I don't know if they'll get executed between now and the end of the day, and I don't really want to carry them overnight. Vanna hedge it. It's a simple trade, one trade, goes and reduces the sensitivity of my entire portfolio to the risk that may exist with those particular positions. That's what that was about. I spend a lot of time really not thinking about how much money I'm going to make, because if all of my options expire to the good and I get to keep all of my money, I know how much I'm going to make. That's not the important factor. It's how much you keep. That's important. Not how much you're going to make. When you sell the option, you're limited on how much you're going to make. It's how much of that you keep. That's important. How much you keep. And so risk management is the biggest part of any of this stuff. When you get right down to it, risk management. The reason why, like the Vanna hedge that we talked about in the last class, I didn't take it off. It's still on in my portfolio. I don't want those positions anymore. They were taken in a VIX regime that doesn't exist right now. If we get back down to that VIX regime, I'll consider taking the Vanna hedge back off. But that's a VIX of 15. If we get to a VIX of 15 this week, we're back down to where we were, and all this was a VIX spike blip. VIX spike blip. And the market kind of corrected itself from a truly overbought condition, and then maybe it'll have a shot to go on. But I don't want to keep positions on that were taken in a regime that doesn't exist anymore. Just get rid of them. That one didn't work. Just say that trade didn't work. That happens. It's kind of like if you're a professional gambler and you go and you live in Las Vegas and you play poker, you don't always win. Sometimes you lose, but you win more often than you lose, so that you're actually profitable. That's the key with all of this stuff. In today's world, you can take an option strategy because you can buy the data from the CBOE. You can take an option strategy, and with the AI tools that exist, if you can define what your option strategy is well enough to where you can write software for it, you can actually test it, back test it. Now you got to be careful that you don't design your option strategy for the back test. You go into it. Here's my strategy. I want to test and see how it would have done in the past, with a belief that perhaps that's how it would also react under similar circumstances in the future. That's possible to do. So, there are more tools available now to going and making options trading safer and more part of a strategy than there have ever been before. And hopefully this sort of data is part of what that strategy can be, because I think it's, to me, again, if I'm thinking of it as a bet, I know what my odds are when I place it. And I love that. Got great confidence because I understand that. Okay. This last slide, I think this is literally the last one. If not, there's probably a question slide. These are the things that you should ask yourself. Why am I doing this? It's the purpose. Why am I doing this? Target of opportunity, that's a 0 DT trade usually. Risk substitution, for me, that's a call trade. Part of an appreciation strategy, yeah, I've got one of those. I've got an appreciation strategy. As part of an income strategy, I've got one of those too. How am I going to size the trade? Okay. Sizing the trade oftentimes has to do with, well, how much money do I want to make on, I told you the story about the person that sells one option per week to go fund their Starbucks habit. Okay. If I can make $50, I paid for my Starbucks for the week. They figured out how to size the trade. They know what they need to make. They're not being a pig. How will I manage the margin required for the trade? Is it a vertical spread? Is it going to be a naked option? If it's a naked option, then I can only trade fewer of those. And I need to have the cash to be able to back that up. Is it a cash covered put? Well, then again, I have to have cash available to cover the cost of if the stock gets put to me. These are all questions that you need to ask. How am I going to do that? What risk do I want to take in the options part of the trade? We give you the entire CDF in 5% increments. So you get to choose. This one is pretty important. What happens if the trade moves against me? What am I going to do? And then this one is also important. Sell discipline, buy discipline, both of those matter. What you want to know what the answers to all of these questions are before you even make the trade. Otherwise, don't make it. And this is where people get in trouble. They don't know what they're going to go do before they do it. And then if you try to figure it out on the fly, that's the wrong time. There's more. Just go through these. I already kind of talked about that. This is the big one. Don't be a pig. Manage your margin. Max purpose. Have a plan. Have a plan. Questions? All right, guys. That is it. That's it. We're finished. One thing I will promise, I have Deval, I think you actually recorded it. There at one time I taught something on how to compute the VIX and use the margin control calculator. And there's a link to it in the Discord, except that the link no longer works. Did you record that?
I may have, and it might have in my Google Drive, and I may have given it.
If it's on your
deleted it or
Google
something.
Drive, if it's on your Google Drive, can you DM me with it? Because I'll put it on my YouTube.
Yeah, hopefully I can, if I didn't delete it.
Well, if you did,
Yeah.
then I'll think about potentially putting another one of those out
Right.
there. That was a
I'll
good
look at it.
class.
Yeah.
Okay.
Cool. Thank you. Thanks, Peter.
All right.
Great.
Thanks, Peter.
All right.
Thank you,
Have
Peter.
a good day, guys.
Thank you, Peter.
Bye.
Thanks.
Bye bye.